Welcome back. Has it really been a month since we last spoke? Well, there's a lot going on, so let's see if we can get you through the next month as well. And there's quite a lot going on in foreign exchange markets at the moment, and we've got a lot of central bank meetings coming up that I think we need to discuss. And one of the things we want to suggest here is that FX markets have become a little bit more volatile, which in certain cases can make them more attractive, of course. So I think realistically, what we're trying to do is to find out where the opportunities lie at the moment. So if we look at the currencies at the moment, we've seen a weekly change at the moment of over 1% in quite a few currencies, 2% in dollar yen. So there's opportunities here, but central banks are getting closer to potentially cutting rates. We know that. But are they all going to cut around the same sort of time? Are the economies in the same sort of position? I don't think so. So this idea of lockstep moves maybe not as valid as some people seem to think, or the strong narrative that's around. And traders are adjusting their central bank rate expectations for 2024 and positions accordingly. So there's quite a lot going on trying to find out where the right levels are, because the central banks are data dependent at the moment, which means we have less information than we normally would have. So it's an interesting time. So looking forward, it's likely that central bank interest rate decisions possibly start to diverge slightly. Now, that gives us an interesting setup. If you look at this chart here on the left, the synchronization in benchmark rates may be over. So as we get this break in the lockstep idea, there's a chance that we get yield differentials. So the yield in one country is higher or lower than that in another, and that impacts the foreign exchange rate, and that opens opportunity for a trade. So at the moment, the focus on their domestic economies are the path of inflation at the moment. Is it continuing to fall as they expected after the rate hikes, or is it lagging or starting to move up again in all economies? The trend of economic growth, whilst they're looking to cut, is the economy weak enough to take that, or could they spark more inflation? Wages and labour market data are absolutely at the centre of central bank thinking at the moment when it comes to cutting rates. And in certain countries, wages are still rising, the labour market is still tight, which suggests cutting rates for an economy that hot or trending pretty well still is very difficult to justify, whereas other economies have weaker situations with rates still restrictive as they are in other countries, but they're doing more damage because the economy is weaker. So I think it's a really interesting setup at the moment for foreign exchange, one of the most interesting situations we've seen in a while. But interestingly, within all this, over the last 4 weeks or 3 weeks, we've seen the dollar starting to adjust lower. The dollar has just had its worst week since December, in fact, as you can see here on this dollar index chart on the right. We've had slightly worse, let's not say bad data, but weaker than expected data out of the US for the first time in a while. Obviously, back in December, we had the Fed pivot where they started talking about rate cuts, but the economy has still been running pretty strong. But we've seen rather disappointing ISM services PMI. And if you remember, we've mentioned this before, but services are what are propping up the main economy. We've had a rather more dovish Fed chairman in his testimony to Congress and the Senate last week. So this has just taken the edge off the dollar, and we've started to see it fall. We've also seen in the data a slight move higher in unemployment rate, moving up to 3.9%, the highest in 2 years, but it must be said, still historically low. So the dollar has reacted to markets pricing in more cuts from the Fed, and more so than the Fed median dots suggest. As you can see here on the chart, this dovish shift in policy pricing is pushing down, and it's going below. There's still the market is still pricing in more than the Fed are. Put it that way, and I think that's dangerous with the economy still running relatively hot. Could there be an impact on the dollar if we get a more hawkish sentiment from the Fed in March? In the meeting next week, it looks clear they're not going to hike. They're not going to cut. But right now, we've also got the situation where yesterday's CPI reading, for instance, is instead of falling, it's going sideways. And in fact, it beat expectations slightly. So the Fed rate decision and press conference on Wednesday, the 20th of March next week, is going to be a big event. And the question is, where next for the dollar and why is it going to move? And I think it's really interesting now where we're sitting in foreign exchange markets and specifically with the dollar and the Fed. The dollar for me is one of these problematic currencies at the moment because a lot has already been priced in. And if we start looking at other currencies, then I think, particularly the euro, the ECB has signaled quite clearly, and particularly last Thursday, that a June rate cut is becoming more likely. Should they go earlier than that is a big question. But they've seen their forecast lowering inflation and growth forecasts, which suggest they probably shouldn't be keeping rates in restrictive levels around 4%. Because if you look at where the neutral rate is, where the economy is not running, the interest rates are not pushing the economy up or down, is probably around 2.25%. Rates are at 4%. That means they're restricted. They are pressing down on the economy. And President Lagarde has said policymakers are more confident on ongoing control of inflation. That means they see inflation coming down to target. The question is, should they wait until they get to that target when there is such a long lag on policy shifts impacting the economy? So this has sent the euro lower, and traders have priced in more cuts in 2024. We saw that if we take the euro Oz, for instance, because the dollar's been falling at the same time, which has given the euro looking to have strength that doesn't necessarily have. But if we look at euro Oz, we can see from the ECB meeting the steep sell-off in the euro against everything. That was a sell-off against the dollar, sterling, yen, everything. We've then sort of bounced back, but there is an increased potential from the speak I'm hearing from the ECB for a cut in April. It's unlikely because they're not a proactive or preemptive central bank. They usually wait for something to slap them in the face before they actually do anything about it, as we've seen in the past. But there is a very strong idea that they're going to cut in June, and their meeting is just before the Fed's meeting in June as well. So could that put pressure on the euro? But we have seen the euro drop and then reverse. Look at this 1 hour chart. It's been quite volatile over the last while. If we see that Euro ECB meeting, we saw that fall. But then straight after the ECB dovishness, we got dovishness in spades from Fed Chairman Powell. And his testimony was more powerful than Lagarde's was. So Lagarde took the euro down, and lo and behold, Powell took it straight back up again. So this is where it's so difficult at the moment to judge exactly where we're going. But I do think Powell testimony was quite dovish. I was a bit surprised about that. But where next for euro and euro crosses? It's unclear with the euro against the dollar. I think we're mid-range. We could move into a slightly higher trading range. We seem to be stuck around 107 to just above 110 at the moment. We need to break out of that range. But I think euro crosses could see further weakness because to me the European or the EU economy is weaker than that of the US. The US can afford to wait longer. I don't know that's the case for the ECB. So therefore, we could see this rate divergence move if the Fed don't go in June and the ECB feel they're forced to, or if the ECB go in April. So I think we've got to be careful that maybe trading against the dollar isn't always the best bet. I think sometimes we need to look at who's going to cut first, second, or third, and who's potentially going to hike or stay with rates higher for longer. And I think that is going to give yield differentials a move, which gives you an opportunity to make money in foreign exchange. So I think some of the crosses could be more important. But then, of course, we come on to the Bank of Japan. The Japanese market is extremely interesting at the moment. There is a real polarized view in Japan. There's talk of a rate hike. This is the last economy to possibly move from negative rates. The issue here is the Bank of Japan seems very keen to get rates away from negative, no matter what. But they've got to be careful because if they raise rates too early, the economy is not that strong. Yes, they've got higher inflation, but a lot of that inflation has been imported via a weaker yen. So this weak yen has helped, but what they need to see is consumer-led spending, which drives inflation higher. Now, they might get that because we have now seen improved wage negotiations going through. We had Toyota just last night coming up with a very large pay packet, 5% plus. This seems to be the norm going through at the moment. But this has led to reports that the BOJ may act to raise rates even as early as March. Now, I think that is possibly a little early. I mean, getting the wage rises in place is one thing. Getting the consumer or the workers to spend that money is another. And by the time they've made those decisions and starts coming through in the data, that we may have to wait till April or even later. But the rate decision is due on Tuesday, the 19th of March, which coincidentally is the day before we get the Fed announcement. And I think we've got to ask ourselves some questions. Is the Bank of Japan decision a binary event for dollar yen? Initially, I think it is, because I think if they come out and say we're raising rates, I think the yen will increase, but it is beginning to be priced to a greater degree. The other thing is they may only hike by 0.1% or 0.15%, and suggest that they're going to leave it to see how things work for a while. So again, we come back to this yield differential. The differential between Japanese rates and US rates will remain pretty wide. Are they going to narrow enough for dollar yen to come off a long way? We've already seen the Nikkei start to drift lower on the back of this expectation of higher rates, but I'm not sure how far it goes. So I think it's going to be fascinating to watch how this moves. But could dollar yen be impacted by the double hit of a strong yen and a weak dollar? Again, for instance, we've got retail sales tomorrow from the US, vitally important data. We've got PPI data, which is part of the inflation dynamic, very important data going into the meeting next week. So, there is a potential here where the Fed could say, yes, we are now committed to cutting, maybe that they give us a bit of forward guidance. And with the Bank of Japan possibly saying they're going to hike in April or hike in March, then obviously that gap's going to narrow, dollar yen's going to go down. But there is a danger that Bank of Japan does not do enough for markets to really get it moving, and the Fed stays relatively hawkish because the data from the US economy is still rather hot. So it's going to be a tough one, but fascinating. But watch those yield differentials. And I think, don't forget, on Thursday, the 21st of March, we get the SMB rate decision as well. Some people are suggesting they may be the first central bank to cut, but inflation's rather mid-range for me to see that this early. But also, we get the Bank of England rate decision as well on the same day. So a lot going on, a lot of yield differentials. Watch the bond markets. These markets are going to move on the back of a lot of this. So I think you need to be aware that there's opportunity here, but just beware around these figures, around these announcements, there's going to be volatility. And remember, not all the volatility comes from the actual rate announcement. Quite a lot of it could come from the press conferences afterwards. So just bear that in mind, because I think there's an awful lot going on at the moment, and we could see an increased volatility in foreign exchange markets going forward for actually the next month. So until we meet again, probably.